Interest rates are at the highest place they've been in almost 2 decades. The 10-year treasury yield's around 4.6% right now, which is the highest that it's been since 2007. Given both fundamental factors at play and technical analysis of the chart, it looks like we are headed even higher. But even just a move to 5.5% will put the yield on 10-year treasuries at a level that they haven't seen since the year 2000. This is leading everybody to wonder, what is the impact of high yields and rising yields on different areas of the stock market and real estate? In other words, how is this going to impact me and my investing? Well, this report was just released by Goldman Sachs, which shows the impact of rising bond yields on different areas of the stock market. And after this, we're going to take a look at how it impacts different areas of real estate investing as well. Well, first we can see what tends to do well when yields rise. We see cyclicals, financials, value, energy, and small caps. Now, last time we were in a long-term cycle of interest rates rising like we are right now was around 1940 through 1980. These were the golden years for value investing. Active investors, people like Warren Buffett and who he learned investing from, Benjamin Graham. It worked so well because of that phase of the long-term debt cycle with interest rates rising. And as the government pursues an inflationary deleveraging ahead of us, we are set to see things like value and small caps again start to outperform. Financials outperforming makes a lot of sense as well because they directly benefit from having interest rates be higher. But I like to highlight for you some of the areas that tend to not do well when bond yields are rising. We will come back to real estate in a moment, but first let's take a look at the rest. We have defensives, utilities, telecom, healthcare, consumer staples, retailers, and growth that all tend to do extremely poorly during periods of rising yields. Even technology tends to underperform. Now, if this list shocks you and the things that outperform when bond yields rise seem like old, outdated dinosaurs whose businesses never really perform well, but everything on the bottom of this list that Goldman Sachs is saying will underperform when bond yields rise looks like the things that you've learned are the things you should be invested in, and they've been what you've been building your portfolio in for the last 10 to 20 years. What you are seeing here is the fact that when you have long-term debt cycles, the next phase always looks very different than the last phase. It is a pendulum. It swings back and forth. The sectors that are hated and abandoned right now are the things like value and energy and small caps and chemicals and auto parts. And the stuff that everybody loves to invest in, like technology and growth, may have already reached their peak or be there soon. Interest rates rose through an inflationary deleveraging from about 1940 through 1980. Most investors, professional investors who have been professional investors for their entire careers, have only been investing since after 1980, when interest rates were falling, government debt was growing, the debt to GDP ratio was growing, leverage was growing across the system. In other words, for the last 40 years, we've had a disinflationary levering up of the economy. But you cannot go below zero, especially once inflation gets out of the bag, which means likely we have embarked now on the pendulum swinging the opposite direction. Instead of a disinflationary 20 to 40 year period, we have an inflationary 20 to 40 year period like we did from 40 through 80. Instead of yields falling that whole time, allowing leverage to grow in the system, yields are going to rise, which will force a deleveraging. Now, many people are obviously very concerned about real estate today and wondering how this will impact their real estate portfolio, especially younger people saying, well, I don't even have a real estate portfolio. I'm wondering if I should buy because I could barely afford to buy right now, and I'd be buying in the worst part of town. Well, just like stocks, there are different sectors to real estate. So you can't just say the real estate market. That's the same thing as saying the stock market, but the stock market is made up of a bunch of different sectors and industries and companies that all perform wildly different depending on what's going on in the economy. For instance, office space commercial mortgage-backed securities are seeing delinquency rates reach levels they haven't seen since 2012 and 2013, directly after the financial crisis. So if your only exposure to real estate is through your automated investing portfolio, or your financial advisor has you in a mutual fund or a REIT, you need to take a look at those prospectuses and you need to see what kind of real estate those funds are invested for you, because most likely they're in commercial office space REITs, meaning you're the bag holder. And this isn't just something people have known about for the last couple of years. All the way back in 2019, when I started my YouTube channel, I was talking about commercial real estate as being something you might want to stay away from because it seemed like it was a little bit overvalued. America has the most commercial real estate square footage per person of like any developed country on earth by a huge margin. And with the shift and acceleration of some of those trends that were already taking place in 2020 and 2021, just speeding those things up, yeah, of course, we're going to have a big correction, a big crash there, lots of defaults, lots of delinquencies. Another area of real estate that is entirely different is multifamily. You take a look at this chart from Bravos Research. It shows the delinquency rate of multifamily housing is near an all-time high. This is another area of real estate that I have always stayed away from, and I have always said, hey, probably not a good idea to get exposure there unless you really know what you're doing. But single family homes, single family real estate investing, it's an entirely different ballgame. When you take a look at mortgage applications all the way back from 1990, we can see on this chart created by Nick Gurley from Reventure Consulting, mortgage applications are at the lowest point they've been since 1995, which itself was just a brief dip below. So we really have to go back to 93, 92 before mortgage applications were as low as they are right now. We can also look at the Home Purchase Sentiment Index put together by Fannie Mae. And we can see that the current level of 73.1 is extremely suppressed. Outside of the last couple of years, you have to go all the way back to about 2013, 2014 before you see the Home Purchase Sentiment Index this low. Now, let me ask you a question about bubbles and market tops. Do bubbles pop and do markets top when everybody thinks it's a terrible time to buy something, or when everybody has euphoria and FOMO and thinks they're going to get rich from buying something? I'll give you a hint. It's the second one. Markets do not die of old age. Markets do not die of price. Markets die of euphoria. Now look back at this chart. Was 2013 and 2014, when sentiment was as low as it is today, was that a good time to buy single family homes, or is that a bad time to buy single family homes? Obviously, it was a fantastic, one of the best times in US history to buy single family homes. Now, part of the problem and part of the thing that made it so good was that it was very difficult to, but you asked the average person at that time and they would have said, no, terrible time to buy. Prices have come back up. The economy is about to crumble. Don't buy a house right now. Things are about to get a lot worse. So when you see the fact that nobody is buying homes right now and everybody thinks it's a bad time to buy. In fact, as of December of 2024, 78% of people said it's a bad time to buy a home. It means prices are not high because of euphoria or because of a bubble. Prices are high because of another reason. And that reason is demographics. Outside of a few cities in Texas and Florida, probably California, New York as well, but for most of the United States, there are way more people who need a place to live than there are places to live. Otherwise, the prices at the level they are at right now, making it cost prohibitive to buy new houses, with mortgage applications being as low as they are, would have already caused a massive crash. The reason it hasn't is because the demand that is there is sufficient even with prices at these astronomical levels. Now, it's not going to be like it was in 2011 through 2015 buying homes where number one, you've got great cash flow. Number two, you've got great capital gains. That's not what real estate investing is doing for people right now. Right now, real estate is a great portion of your portfolio. I usually recommend about 30% or a third of your total investable assets in real estate. That's equity, not property value. And that's investment properties, not personal residence. But real estate as a portion of your portfolio acts as a stealth wealth builder for you, a preservation of your purchasing power from inflation, a way to short the dollar, and a way to get some tax benefits. Because with real estate investing, you are using leverage. And so you are able to buy more of an asset than you could with just your dollars. And the debt service, the cost of paying for that debt, is paid for by somebody else, which means your equity is automatically growing, paid for by somebody else. So you get to short the dollar using the real estate as a vehicle to short the dollar by borrowing, and then have that paid for by somebody else. Now, it's harder to find deals today. Maybe you have to have a higher interest rate on your debt. Maybe you have to put more money down. But if you are building a larger real estate portfolio today of quality single family homes that still cash flow in growth markets, you are setting yourself up for some very good long-term success. I've had the exact same outlook on real estate since 2019, when pretty much everybody in my field had been calling for a crash the entire time. And nothing about what is happening going forward into 2025 looks like it could change that at all. So rising yields will certainly have an impact on different sectors of the stock market, with things like cyclicals, financials, value, energy, and small caps doing extremely well, causing a rotation out of things like growth and healthcare and utilities and defensives. But real estate being negatively impacted by rising yields has to be broken apart, just like we broke down the different parts in the stock market, with things like commercial properties, especially office space, being very negatively impacted, multifamily being negatively impacted, but single family, especially if you know what you're doing, you pick the right markets, you're still cash flowing, will be like planting seeds that turn into fantastic orchards in the future. And by the way, if you are interested in my Century portfolio, that's the stocks that I have handpicked that I believe will generate fantastic returns for the next 100 years. I've put together a mini series. It's completely free that walks you through the selection process and criteria that I use to find stocks that I will own for decades. I also show you the exact ticker symbols of all the stocks in my Century portfolio. There's about 11 of them. And I walk you through the best way to be able to automate that so you can invest in these companies and not have to think about it, put it on autopilot, and build your portfolio. If you're interested in that, again, it's completely free. You just have to click on the link in the description below. As always, thank you so much for watching. Have a great day.